Chris Gothard, he's the head of currency at Brown Brothers Harriman right here in Hong Kong. Chris, what a wonderful morning to come in on for us, because you booked yesterday, but S&P comes out today. Let's just to recap Paul Volcker then. He says there's no reason for worry, eventually get resolved. The Treasury in the US just saying these headlines, Congress must act to avoid default, and the deficit reduction plan needs bipartisan support. The S&P announcement shows Congress must act quickly. So, how do the currency markets react?
Well, I think what we have here, John, really is an example of what's dominating currency markets this week and actually really even in recent months, which is political headlines. The fact is that, yes, the S&P downgrade, putting it on negative watch, it doesn't look so good. The Moody's is actually specifically tied to the debt ceiling. The S&P is probably more pointing out the fact that the US really has to come up with a proper budget plan, a proper plan to actually sort of attack what is, not an insignificant amount of debt. Nevertheless, in some ways, Volcker's words might actually be, useful to take wind of. We think that eventually, once you get all the political kind of wrangling out of the way, there will be a solution in the US. I think one of the more serious situations that's going to happen for us, the US situation will be solved before the European situation, put it that way. So at the moment, I think the debt ceiling also, it's not that it's a red herring, but it's about money already spent. It's a bit like going out for dinner, staying in a hotel, having breakfast, and then refusing to pay the bill. It's not really on, to be perfectly honest. Yeah, exactly. So, but I think the next stage is actually for the US to actually sort of tackle its budgets, its spending over the next few years, and its borrowing, of course, over the next few years. And that's probably what the rating agencies, whatever credibility we give them, that's probably what they're actually kind of pushing towards. And in terms of the dollar, in terms of the currency market, I don't think people are taking that too seriously. What you saw this week, which the markets took seriously, was the first portion of Ben Bernanke's testimony, where he perhaps, gave a little bit too much emphasis to the fact that the Fed would react, say, if inflation slowed or even started moving down towards a deflationary situation, or growth actually got a lot worse. And I think the markets read too much into that. You saw the, the level of response that you got in the currency markets. Again, a sign that currency markets incredibly short-term driven at the moment. It's all about headlines. That produced like a huge sort of dollar sell-off. The euro, which of course in the earlier part of the week had a terrible time with a lot of the concerns coming out about Europe, suddenly was back up at 142. In some ways it doesn't make sense. Very short term.
I must ask you though, Chris, S&P, Moody's, Fitch, when they come out with these announcements, this week we've had this US Treasury auction. Demand was 3 times what was expected, so that's been brushed aside, the whole Moody's warning. Now S&P this morning, when you look at the currency markets, does it matter anymore? Obviously it matters, but does it matter as much as it used to matter? Moody's or an S&P warning?
Yeah, well, in some ways, no. I mean, in some ways, the credit rating agencies, there is an element of a pinch or perhaps a slightly larger amount of salt taken with what they're doing. Often they're seen as behind the curve, not really leading events, but rather reacting to events. And you can see that by the way they've reacted to Europe recently. For instance, in the next few weeks, we're expecting a whole raft of downgrades about Italy and Spain, as if, we needed to know that, So in that sense, they don't. And also the other thing to remember is that, like I said, the currency market at the moment, very short term. There isn't a long-term situation where we're concerned about US debt yet.
But it's risk-off, isn't it? I mean, the safe haven currency, particularly in emerging markets here in Asia. Aussie dollar, for example, the Kiwi dollar, record highs this week, so
Well, I mean, that I think is more about in a world where we've got a lot of uncertainty, and you've got somewhere is paying you yield. So in Aussie, you're talking about 4.5%. Kiwi, okay, only 2.5%, but the economy is looking like it's recovering. So we do have markets where people are trying to put their money where they can actually get something for it. Obviously, interest rates are incredibly low in a whole raft of major currencies. So this is where you see some of the spillover, if you like, into currencies like Aussie, Kiwi, also some of the emerging market Asian currencies, because there's still a pretty good story out there. I mean, our concerns about EM Asia obviously is that the Western story, the story in the developed economies, is going to end up overtaking what's happening in the Asian. And you saw the Bank of Korea yesterday citing very specifically the European problems is actually the biggest risk we face going forward. So that. I mean, to a certain extent, we are still constructively positive on those currencies, although we don't think there's going to be too much more in terms of major advancement in those rates. But nevertheless, we don't see, unless there is a major disaster in Europe or the US, a double dip perhaps in the US, we don't see a big sell-off either.
Chris, thanks for coming in. Chris Gothard there from Brown Brothers Harriman.